The simplest way to avoid losing money in the stock market is to simply not own stocks. But stocks can be a profitable passive investment for busy investors who understand how the stock market works, they're aware of stock market cycles, and they've chosen how much risk they want to take on from stocks. That's what this video is about. After being a stock market investor myself in the bear markets of 1987, 2000 through 2002, 2007 through 2009, and the bull markets in between. Hi, my name is Camille Gaines. Welcome to Retire Certain. This channel is all about helping people, one, build wealth with slightly alternative methods that don't take decades, and two, creating diversified income streams so you can live well. I'm not a financial advisor, so I'm not trying to sell you wealth management services here. I'm just a little bit of an investing nerd, and I'm an accredited financial counselor, but mostly I share what I've learned from personally investing for almost 40 years now and from creating diversified income streams for the past 15 years. So as a disclaimer, I must say, do your own research and or hire a financial advisor or a financial planner if you feel like you need one. Now, this video is more about big picture understanding the stock market and how it works and what kind of losses you can have from the stock market. It's a big picture perspective that you're going to want before you invest in stocks. I'll do another video on things like protective puts and more strategies that you can use, buying bonds and things like that to offset or to reduce stock market or portfolio loss. In this video, what I really want to focus on is understanding from a big picture perspective some things, and this will probably shift the way that you're thinking about investing in stocks. The very first thing is understanding what defines a loss in the stock market. There are two types of stock market losses. One is a loss that's reflected in your net worth, while the other is what I call an official loss. Now, let me explain this first, because before you can address how to avoid losing money in the stock market, it's important for you to know what kind of loss you're trying to avoid, right? You have to define what loss is to you. And this gets a little bit geeky, so stay with me because it's super important to know this if you're invested in stocks now or you want to invest in the stock market in the future, or even if you're working with a financial advisor. So first of all, a decline in net worth is the first kind of loss, and I like to look at it as a decline in my net worth. From the very first and most common kind of stock market loss is called an unrealized loss in financial and tax lingo, an unrealized loss. Okay, so an example of this, let's say you invest $100,000 in an S&P 500 index fund. And for example, say that the stock market goes down after you buy it over the next, say, 18 months, and it drops by 50%. You don't sell your stocks because you know that stocks are eventually going to go back up, and you invested for the long term knowing you were going to ride out these ups and downs. Okay, this is an unrealized loss. It's probably a temporary decline in the value. It is a temporary decline depending on when you bought it, really. But if you've had stocks for a while, it's a temporary decline in the value of your stocks rather than a permanent unrealized loss, right? So it's more of a temporary thing. This is because based on history and math, my favorite investing tools, the S&P 500 index we know will increase back above where it was when that 50% drop occurred, or the 50% drop being a bear market, right? So this all sounds fine, right? You're thinking, well, okay, well, I know that my stocks are going to go back up in value, so that's probably okay. But is it okay? So I don't know if it's okay for you or not. Everybody has to decide what depends, depending on what works best for them. So here's what I want you to understand about an unrealized loss, because it doesn't really sound that bad if it's temporary. I want you to understand how it affects your net worth and how it affects your level of wealth. So if you look at, for example, your net worth, if you update your net worth, if you do a statement or you look online where you track your net worth, your wealth, your level of wealth will reflect that 50% decline in value in your stock. So your net worth will have dropped to reflect the current value of stocks at any given time. Now, again, based on history and the stock market, and assuming that you've invested in good quality stocks eventually return to their pre-bear market prices. Okay. Now, the other kind of loss, and that was an unrealized loss. Okay, the value went down. All right. The other kind of loss, the official loss, I like to call it, or in financial and tax lingo, is called a realized loss. Let's talk about that one. In this example, same example, you spent the money and the S&P 500 index, and it dropped by 50%. You would have, if you sold that investment, you would have a realized loss. So the realized loss comes from when you sell something. The unrealized loss is when you don't sell it, it just drops in value. And it's super important to understand that. So the very first step in, avoiding losing money in stocks is understanding what kind of loss you're willing to take and how much you will be affected by that. Clarifying this up front gives you peace of mind, and it helps you from the standpoint of being prepared when bear markets do happen. The very next thing that you can do to control or lower or avoid stock market risk is simply to be realistic about it. Okay, if you're invested in stocks, your stocks will rise and fall really every single day, right? Unless you're invested in some kind of stock that has absolutely no trading volume. We know stocks are going to go up and down every single day. This constant price movement naturally is going to then trigger unrealized losses and unrealized gains, and often, just minimal temporary gains and losses in stocks. While stocks usually just move up and down just a little bit every day, it can add up over time, right? Especially when it starts heading in one direction. And sometimes the stock market as a whole will drop, more than a year or more than 50% based on history. We know that. Here's the great news for stock investors. Fortunately, over very long periods of time, the stock market as a whole increases in value more than it decreases in value. This fact is what attracts investors to attempt to build wealth passively over time from stocks. Here's the important task that's at the core, really, of controlling losses in stock market investing. It's up to every investor to decide, one, how much unrealized loss or temporary decline in value they will tolerate, that is okay with them, and two, how much realized loss they're willing to have, if any. Many investors don't realize that they get to choose how much risk that they want by answering those two questions, by defining those things up front before they invest in stocks. So this is super important to change your confidence around investing in the stock market. When you choose how much risk you want from the stock market, you are no longer a victim of the stock market. And that's how so many stock market investors feel. This removes the victimhood, though, and it puts you in control as an investor of your money. So be realistic on the fact that the stock market losses are part of stock market investing, and that these losses can be temporary or not, depending on whether you sell your stocks, that you can make that choice. Now, the next big factor in controlling stock market losses is time frame. Quite simply, the time frame you invest will determine if you make money in stocks or not for most time periods. We know this is true because, as pointed out earlier, the stock market is always increasing in value over long periods of time based on history. If it stops increasing in value over very long periods of time, we have a way, way bigger problem than our stock investments, right? But so let's just go with everything's good, and over long periods of time, stocks are going to continue to rise. They always have. For example, and without going into too much of this in this video, you can watch my other video about this. If you buy stocks and you hold them usually for 13, 14, 15 years, the probability is very, very high you will make money in stocks, not lose money in stocks. But here's another thing is if you buy stocks when they're extremely overvalued and you sell them 5 years later, well, the probability is much higher that you will lose money from stocks. You can watch my other videos where I talk more about this. Look for the ones where I'm standing at the whiteboard and I have my drawing of the stock market cycles. The next factor in controlling stock market losses will help you understand this better. This is to be aware of stock market cycles. One of the best ways to avoid losing money by stocks is understanding stock market cycles, those long-term cycles. The stock market moves in cycles. The up moves are called bull markets, which the market rises, and then bear markets, the market falls by 20% or more. These cycles are usually, but not always, related to what the economy is doing, as you may have seen in some of my other videos. This makes perfect sense, even though the timing on the economy and the stock market movement is not exact. Let's think about this and see how much sense it makes, though, right? It seems sometimes the economic stuff just seems complicated, but it really makes a lot of sense. Stock markets generally rise when companies that offer their stocks on the market make more money, since investors are happy to pay for those higher earnings that the companies are making. And when those earnings fall, investors sell those stocks because they want to go where opportunity is, other places to make money. Sometimes earnings slow before bear markets, and sometimes they slow after bear markets, and sometimes the timing is very, very close, but the timing can be a bit tricky. And the very next factor to help control losing, you help you control losing money in the stock market is to use basic historical data. Nothing complicated or complex, just basic historical data. This is one of my favorite investing tools. When you invest in stocks, you can easily look to see where the stock market cycle is relative to history. It makes sense to do this before you buy stocks. And while you own stocks also, you can do this periodically, or if you hear something on the news that makes you get worried or concerned, you can look and see where stocks are in the stock market cycle. Now, here is what's a little bit tricky though. If the stock market has been going up for a really, really long time, it's closer to falling because the stock market will become so overextended, it needs to correct or enter a bear market. It needs that in order to flush out that overvaluation. On the other hand, if the stock market has fallen significantly and it's more likely that stocks will rise. Doesn't that seem weird? Another way to avoid losing money in stocks is buy what everyone hates. And this is related to the one that I just talked about. Here's the thing. After stocks have fallen by 50%, everyone hates stocks. Nobody wants to buy stocks ever again. Based on history, though, this has been a great time to buy quality stocks. And buying stocks at lower prices naturally lowers stock market risk. It lowers the likelihood that you're going to lose money in stocks. Because when you pay less for something, you have less risk, especially when you're buying it at undervalued levels, relative to what you're getting. On the other hand, after stocks have risen for 10 years, everyone loves stocks. This could be the time to take some profits, depending on the amount and type of risk. Remember, you have decided that you want to take. Circling back to that very first point about the types of losses that you're willing to take and how much of a loss you're willing to take. The very next factor to avoid stock market losses is not to follow the herd. And this relates to the last 2 points that I made. This is really hard since as humans we have primal instinct to stay with the herd. It's left over from our cave dwelling days. Plus, we're taught as children not to act differently. Don't be too different. Culturally, it's not acceptable. And it certainly wasn't safe to act differently from everyone else when you were a child, right? Weren't you encouraged to do what everyone else is doing? I was. So for this reason, most investors are driven to buy stocks near highs because everyone else is doing this. They're buying stocks near highs and then selling stocks near lows because everyone hates stocks. First, defining how much risk you want to have and holding firm to that place of decision will help you have more confidence around investing in stocks and help you avoid losing money when investing in stocks because of the overwhelming herd mentality, that drive to do what everyone else is doing. Now, the next factor that I wanted to mention to help you avoid losing money in stocks is just to avoid buying overpriced stocks. This will naturally come about. You will naturally avoid buying overpriced stocks if you do the other things that I've mentioned in this video, like, buying when everyone hates stocks, for example, or after they've fallen by 50%. If you have stocks that have unusually high valuations, especially after the stock market has been rising for many years, a long, long time, there's a higher probability, I hate to tell you, that you'll lose money in stocks. But stocks with lower valuations and sometimes, kind of boring, somewhat stodgy dividend stocks tend to drop less during market corrections or bear markets, thereby at least minimizing stock market risk. Now, I want to point out that many investors think because they're invested in quote unquote conservative stocks, they won't lose money when the stock market tanks, but almost all stocks go down during bear markets. It is true, however, that during bear markets, dividend stocks drop less than the overvalued stocks that have usually driven the market up that don't pay dividends, since investors, they want to continue to own those dividend stocks because they're getting the dividends from them, right? There's still an incentive there. Again, the only way to avoid losses in stocks is not to invest in stocks at all or to have a perfectly hedged portfolio, which I'll talk about in another video. This is rare, if not impossible. But by defining acceptable stock market risk and investing with an awareness of market cycles and valuations, you as an investor can at least mitigate stock market losses, if not make money instead in the stock market. Many investors and financial advisors focus more on portfolio risk than just stock risk by buying both stocks and bonds. This is good because quality bonds usually move up when stocks go down. I've done another video on that, so be sure to check that out. Unfortunately, this hasn't always been the case. And I wrote about this in a long article at my website, retirecertain.com. If you want to read that article and see the chart that I made with the information in it, just Google what goes up when stocks go down. And I think it should come up on page 1 of Google. What goes up when stocks go down? And it should appear. And you can check out that article. If you want to know more about stock market risk, you'll want to watch this video next. In the meantime, build wealth, create income streams, and live well.